welcome. You're watching Buy Now, Sell Now. I'm with you, Kavita Thapliyal. With me is my colleague, Ankita Saxena. And yes, a show where we answer your stock-specific queries. But before that, we know it's a Q4 earnings season. And joining us is KFIN Tech management. And yes, as far as the results are concerned, margins have dipped quarter-on-quarter. Profit revenue has declined on integration and strong year-on-year growth led by global business. But then what's in store? Let's chat up more. We are joined by Mr. Sreekanth Nadella, MD and CEO, KFIN Technologies. Hi, morning, and welcome to the show. So let's just talk about the revenues first. Revenues, the gap that we have seen between revenue growth, the 19% and PAT growth. How would you like to explain the driving factors over here?
You are aware of the fact that we have completed the acquisition of international fund administrator called Ascent Fund Solutions. That's fledgling, fast-growing fund administrator who's present in 18 different countries. Now, we have completed the transaction in the month of October, and we have consolidated the results ever since. That has added a top-line growth, which is reflecting in the form of 19% that you're talking about is the overall full-year number. For this quarter, it is close to 23%. But obviously, given it is a reasonably new organization, which has just broken even, clearly there has been a downward pressure in terms of margins as we have consolidated the accounts. But the core standalone KFIN Technologies, PAT continues to be robust. It's positive. So it is effectively the consolidation effect, as well as clearly there has been a little bit of mark-to-market impact in Q4, given our organization has a symbiotic relationship with what happens in the markets.
Hi, good morning. This is Ankita also joining in. Also tell us, what is the organic growth trajectory of the international business post the Ascent normalization? Give us some color on that as well.
Going forward, the year, of course, is choppy. Guessing where the market's head, is anybody's guess at this point in time. I think what we, however, on principles of conservatism, have arrived at, we just completed our annual budgeting exercise, so on and so forth. And we believe that we still have a 24% thereabouts top line growth visibility, with a EBITDA growth around 16% and a PAT growth anywhere around 10 to 11% for the upcoming year.
Let's just talk about the EBITDA. EBITDA margin dropped from 43.9 to 40.7%. Now, what is the steady state margin post asset integration, and can we sustainably return to 43 to 45% range?
Definitely. There is no reason for us to not to be able to. As I said, it is a consolidation effect, not to mention, obviously, the mark-to-market impact that we have seen across the markets for the last good part of the last year, which effectively has a downstream impact in terms of our total revenue, given our commercial model is that we charge some basis points on the assets under management of the industry, which is directly related to the markets as well. We do believe that in the, even in the short term, definitely in the medium and long term, given the financialization story of our country, the overall mutual funds, AUM, the alternative asset classes, the security markets, the secondary markets primarily, will continue to be fledgling. In that context, for us to return to 43 to 45% is, probably 12 months away. That said, we have always been guiding, anywhere between 40 to 45% as a very sustainable number. We may have, 1 or 2 quarters which are entirely dependent and driven by the macros, which can drag the numbers down to 40.7, 41 where we are. But on a sustainable basis, 43 to 45% is something we should be able to get back to in about 12 months from now.
Mr. Nadella, so what percentage of the revenue is now non-market linked, recurring annuity? Tell us that about that as well.
India mutual funds business contributes about 58% for our total book, right? That is obviously directly dependent on the markets. Our international business also is dependent on the markets, but of course that is dependent on the global markets and not necessarily Indian markets, and that is exactly the diversification we wanted to accomplish across asset classes, across business processes, and across geographies. So if you add the exposure of the funds that we have both domestically as well as international, that will be close to about 70, 72%.
What is the blend revenue yield across domestic mutual funds, international funds, AIFs, if I have to ask? And also, where is pricing pressure highest today?
See, yield is a factor of multiple things. Pricing pressure is one of the factors. That is not the only factor. The yield, of course, is a number that you compute across the clients, across asset classes. Typically in mutual funds, for example, there is a differentiated rate, depending upon whether it is actively managed equity funds or a debt or a money market funds or an ETF, so on and so forth. So it is basically average of averages. Discounts driven by pricing conversation is a factor that probably has a bearing of 30 to 40%. The rest of it is asset mix, right? I mean, if there is a disproportionate increase in, say, passives, as we have seen in Q2, Q3, and Q4, thanks to a dramatic rise in the metal-based ETFs, right? Especially the silver and gold ETF. Those will have downward pressure on the yield, but by and large, our yield had been reasonably stable. We believe that within probably on an average of about 1 to 1.5% of yield correction will happen every year. Part of it is because of the pricing pressure, part of it is because of the asset mix, and also depends on which of our clients is growing faster than the other, because the pricing is different for each AIMS.
Mr. Nadella, also your AUM growth has been around 21%, which is in line with the industry. But how much of this growth has been market-linked versus net inflows and versus the client additions as well?
Most certainly. Our growth this year, it is almost all of it is, thanks to net flows, right? I mean, 21%. There has been, net, mark-to-market, reduction. So you have to attribute almost all of it to the net flows, which obviously also requires significant efforts on our part in terms of the operations that we, handle and scale. So I take heart from the fact that given what may look like a very bad year in terms of the markets, we still have a 20% uptick in the AUM. Which effectively means that in a good year, what could be, in terms of, what more growth we could see. On the issuer solutions, where we manage the registrar and transfer agency work for listed and unlisted companies, we have grown about, 11% overall for the full year. Now, that is despite a significant exodus of, mass retail investors from the secondary markets. That growth we could still orchestrate on the back of, significant new client wins as well as transitions from our competitors. So with the markets turning around, with the retail investors coming back, we hope to see a much better year ahead in terms of the registry work. In terms of the net new client wins, in the case of mutual funds alone, we have signed 4 mandates this year, 4 new asset management companies, very prominent, very notable ones, and we believe that we have a very strong future with them. Internationally, we have expanded our count quite a bit. With the inclusion of Ascent, we now manage close to 1,000 fund managers across the globe, across 18 different countries. Organically, we manage about 110, 120 ourselves across Asia. And with Ascent across the globe, including Cayman, including Europe and Americas, we manage about 1,000 plus fund managers. So that's a very large scale expansion in terms of the total client contracts we have. On the alternate investment funds, also we have grown by about 25% in line, slightly ahead of the market in terms of addition of the net new funds. That is launch of new schemes as well as the new funds. And National Pension System has been a big win for us this year. We continued for the 3rd year in a row to grow 3 times the speed at which the industry had been growing.
All right, Sreekanth, thank you so much for joining in and talking to us on the results today. Thank you. So let's move on and let's